Two of the most talked about income-generating ETFs, JEPQ and JEPI, are back in the spotlight today. But hold up, something's changed. If you're an investor looking for passive income, these ETFs have likely been on your radar. But which one is the better choice right now? And why has one of them underperformed? Stay tuned, because in this video, we're breaking it all down. Dividends, volatility, performance, and which one is still worth your money. First, let's get a quick refresher. Let's introduce both ETFs for investors who may be new to them. Both JEPQ and JEPI are actively managed funds issued by JP Morgan and considered non-traditional equity ETFs. Both have a relatively short history, but they both gained popularity rather quickly. JEPI was launched on May 20th, 2020. JEPQ is newer, with an inception date of May 3rd, 2022. Since their inception, both have grown to a sizable asset under management. JEPI's current assets under management sits at $38.57 billion, compared to JEPQ's $22.45 billion. In terms of the underlying strategy, both funds share similar investment methods. Both funds use a proprietary algorithm to pick their holdings and use an ELN overlay to generate income. Thus, both have Premium Income ETF in their names. The difference is that JEPQ focuses on NASDAQ equities, while JEPI focuses on the S&P 500. JEPQ's fund description says JEPQ actively invests in U.S. large-cap stocks comprising its benchmark, the NASDAQ 100 index, while pursuing lower volatility. The fund may also invest up to 20% of the portfolio in equity-linked notes, ELNs, issued by counterparties including banks, broker-dealers, or their affiliates to provide additional income. JEPI's fund description says JEPI is an actively managed fund that invests in large-cap U.S. stocks and equity-linked notes. It seeks to provide similar returns as the S&P 500 index with lower volatility and monthly income. JEPI curates its portfolio by selecting stocks from the S&P 500 index, using a process to identify value stocks with favorable risk-return characteristics, along with ESG considerations. JEPQ and JEPI are dividend-focused with monthly dividend payouts for both funds. Both funds have similar 4-year average yields according to these statistics, with JEPQ at 8.60% and JEPI at 8.62%. Both JEPQ and JEPI are actively managed ETFs. As we mentioned previously, each uses equity-linked notes to generate extra income, basically a way to profit from market volatility. Again, JEPQ focuses on NASDAQ stocks, where JEPI is based on the S&P 500. Both have an expense ratio of 0.35%, higher than index funds but reasonable for active management. Historical data shows that JEPQ has demonstrated lower drawdowns compared to the broader market during market downturns. The use of options and the underlying screening method are structurally sound approaches. One might expect it to keep generating lower volatility, lower drawdowns, and higher income in the case of a hard landing. As for its sister fund, JP Morgan Equity Premium Income ETF, JEPI, the analysis dates a bit further back to May 2020. Now here's where things get really interesting. How have they performed recently? Since August 2024, JEPQ has been crushing it. JEPQ's price jumped 9.49%, delivering a total return of 14.70%. Meanwhile, JEPI's gains were more modest, trailing behind the S&P 500. JEPQ is not just outperforming JEPI, but also beating the S&P 500. However, both funds have similar 4-year average yields, with JEPQ at 8.60% and JEPI at 8.62%. Now let's talk about the real reason why most investors buy these ETFs. It's the dividends. So what is JEPQ's current yield? Well, it's a whopping 9.37%. And what about JEPI's yield? It stands at 7.13%. And here's the key takeaway. JEPQ's yield is actually higher than its 4-year average, and JEPI's yield is lower than its 4-year average. So what does that all translate to? JEPQ is a better value right now, while JEPI is getting more expensive relative to its history. What is the reason why JEPQ is outperforming? It's volatility. The NASDAQ 100 is indeed more volatile than the S&P 500. More volatility, however, equals more income from option premiums. But here's the twist. The market seems to be mispricing this volatility. JEPQ's current income is higher than usual, and JEPI's current income is lower than usual. Now, before you go all in on JEPQ, let's talk about the risks. Both funds are sensitive to market downturns. JEPQ has more concentration risk. Its top 10 stocks make up nearly 47% of holdings, versus just 16% for JEPI. Plus, higher turnover rates equate to more fees and potential tax consequences. Both of their price movements have been highly correlated in the past. In terms of risks, JEPQ entails much higher concentration risks. JEPQ holds 105 assets, while JEPI holds a larger number at 129. JEPQ's holdings are highly concentrated, with 46.59% of its assets concentrated in its top 10 holdings. In contrast, JEPI is much better diversified, with only 15.91% of its assets concentrated in the top 10 holdings. Finally, as actively managed funds, note that both funds demonstrate very high turnover rates, with JEPQ at 168% and JEPI slightly higher at 174%. To better understand these figures, the turnover rates for large passive index funds, such as SPY and QQQ, are mostly below 10%. Higher turnover rates tend to correlate with higher trading frictions, fees, and also tax consequences. So what's the bottom line? Well, JEPQ is yielding more, benefiting from the volatility and outperforming the market. And JEPI is still a solid fund, but its yield is underperforming historical averages. I believe in being honest and transparent with my audience, so I want you to know that I personally hold a significant position in JEPQ and I'm very happy with it. What do you think? Are you on Team JEPQ or Team JEPI? Drop us a comment below and tell us if you are a fan of these or maybe some other dividend funds. We can all learn from each other. And don't forget to like and subscribe for more investing insights. Thank you for watching. We look forward to seeing you again next time.